This video covers perfect competition. It'll develop a very powerful and insightful model. This video employs the cost curve concepts we developed in the last video. So this video is kind of sandwiched between cost curves that we studied in the last video, because if you don't understand those cost curves or you haven't looked at that material, this video will be very hard to follow. And then the next video is on monopoly. And then the next one after that, monopolistic competition. If you don't understand perfect competition, the assumptions, then the next two chapters are going to be difficult to follow. So this is a linchpin here, perfect competition, sandwiched between other videos. So make sure you get a grip on what this chapter is saying. Now, towards the end of the last video where I covered production costs and then I talked about a supply curve, this video brings in price into the picture. I only discussed it a little bit at the end of the production cost video, but now it's a central point in this video. So price comes into the picture. We'll use marginal analysis to determine Q, the quantity of output that a firm must produce to be efficient and to optimize. And then the question is, well, at that Q, are we profitable or are we not? And if we're not profitable, then we should get out of business. If we are profitable, that's good. Let's look at the the analysis tells us, and then we'll look at the implications of that, because it's a little more involved than what I'm describing here. There's short run and long run implications, which ultimately boil down to, should the firm produce in the short run or shut down in the short run? So that'll come into play in this chapter. Now, we'll also look at the relationship between the firm and the market for the goods. So we'll look at the firm, or what we call the industry sometimes, and then the firm that's within the industry, and work off of both of those and look to see how they interact. Then we'll model an increase in demand in the short run and the long run for the firm and the market. So we'll look at a firm that's in perfect competition. We'll increase demand and see how the firm reacts to that increase in the demand. And then we'll look at how the industry reacts to that. And then we'll look at both short run and long run implications. This video, as I said, is a prerequisite for the next two videos on monopoly and monopolistic competition. Now, let's look at the assumptions behind perfect competition, a perfectly competitive market. And these will be key, and we'll relax and change some of these as we go along in the next couple of chapters. So first off, in perfect competition, we have many producers. There's many firms. They're small. They're sometimes called atomistic, meaning individually they're small. And because they're so small, they're price takers. They don't determine or set the price. They don't have control over price. A monopoly has control over a price. But perfectly competitive markets, firms don't have control. There are many consumers, and they are price takers. So there's no particular person that can move price. Just like there's no producer that can change price. They're taking the price as is. Consumers are price takers, and most of us can understand that. But the other thing is there's no Walmarts that sometimes are consumers in a sense from a wholesale level. Walmart can control price. They can dictate the price that some of their suppliers supply to them for, and that's ruled out of here. So both producers and consumers are price takers. And in this analysis, there's a standard product, sometimes called a commodity, and it's sometimes helpful to think of it this way. Literally a commodity such as wheat or corn. So you got number 2 yellow corn. And number 2 yellow corn with a certain humidity, and so it's not wet, it's not moldy, it's got a certain quality to it. It's a standard product, so people in the industry know what number 2 yellow corn can do for you. Same thing with wheat. The same thing with steel, for example, a certain composition, a standardized quality of steel. So that's what we mean by a commodity. It's indistinguishable. From the units are indistinguishable. We'll also here assume that there's free entry into and exit from a market. In other words, there's no barriers. You can easily move into a market and you can easily exit from a market. There's no costs that stop you from doing that. So in the real world, there are some heavy upfront costs that make it difficult to move in, say, to open up a bank. Or you got to go through a lot of regulatory hurdles and have a certain quantity of money to be able to do that. We're assuming that away. This is an important assumption to distinguish between the long run and the short run, as we'll get into. The short run is where the number of firms in the industry is fixed. So remember, we looked in the past at, in the last chapter, we looked at fixed costs, which meant that there was a fixed input to the process. And we said in the short run, there was, fixed floor space to a business, a fixed amount of acreage to a farm. So that would designate the short run. Now, imagine that you could increase your floor space. So you can have a bakery with a bigger floor space. You can have a plant with a bigger floor space, or a farm with a bigger floor space. You've just relaxed that fixed assumption. And when we do that, we're thinking long run. In the long run, you can change those elements that are fixed. And so we carry, sort of the same concept into this chapter with this fixed versus fixed in the short run, and the long run we're opened up to vary whatever we want. We'll also assume that buyers and sellers are well informed so that there's no asymmetric information between buyers and sellers. And even, buyers know what prices are, the quality of what they're buying. And the same thing with sellers know what they're selling relative to other sellers. Now, despite the heavy assumptions, this model has heavy assumptions, so much so that there's almost no item in the world that's quite perfect competition. It's just not there. But the model, like I said, is extremely insightful, and it's a benchmark theory because we're going to leverage this chapter, this video, for the next couple of chapters. So it's interesting what this model predicts. It's an interesting benchmark theory of what we call market structure. And market structure has to do with what are the characteristics that describe the market, especially the characteristics around how much competition there is, how many producers and sellers there are in a particular market. Those types of characteristics determine market structure. So this is a benchmark theory in market structure. You can't really get to you can't really get a good handle on the other types of market structure like monopolies and monopolistic competition without first understanding perfect competition. Let's start off our analysis of perfect competition looking at the bakery example again. This time we are selling cakes at $15 a cake, and we have output from 0 to 900 units. To be true to form here, in other words, to be consistent with perfect competition, this firm is not a retail bakery. A retail bakery in most instances would be monopolistically competitive. They have a niche, they have a certain brand, they can control price to some degree. And so that's not what we're talking about here. The example would be, say, a wholesale baker that produces unfinished cakes and sends them off to grocery stores for finishing. And then the grocery stores can take those and finish them in their own fashion and add an element of uniqueness to the cake. The cakes that we're looking at here in this bakery are pretty generic. So I've built a table here with the relevant costs and revenues associated with it. Notice revenues this time brought into it because we have a price. So the first column, like I said, is output of cakes. It goes from 0 to 900. Our total revenue with a price that's fixed at $15. So no matter how much this bakery sells, the price is set at $15. That's determined by the market in perfect competition. This is a bakery that's small and can't control price. So it's $15. And so when you see, as we see in columns 2, 3, and 4, the word total, you see there it's basically cumulative. It's not on a per unit basis. And that's important to know because you're going to look at a lot of cost curves here and revenue curves, and your head's going to start to spin because they all sound the same. Keep in mind that the totals are cumulative effectively, And when we get to averages and marginals, it's on a per unit basis. So we have column 2, total revenue, which is just quantity of cakes times the price of $15 per cake. And we come down, we can see total revenue accumulating. That makes sense. The total costs are accumulating also. Total costs start out at $500. That must be a fixed cost. If we have no output and we have a cost, that has to be a sunk cost of $500 fixed. And then what happens is total costs start to accumulate because of the variable costs accumulating there. Total profit is just the difference between total revenue and total cost. And it starts off negative, plateaus in the positive territory, and then, which kind of makes sense. You want to be able to make a profit. And then it tails off with, I guess, call it overproduction, if that's a term. You're overproducing. And so it tails off. So we're not going to graph that total profit curve, but if you wanted to imagine what it looked like, it would look like an upside down U with both tails in the negative territory, which tells you you don't want to produce too little and you don't want to produce too much. You want to produce somewhere in the middle. And the reason why you don't want to produce at the low end of the scale is because you're not covering your fixed costs initially. You need to sell enough units to at least cover your fixed costs. And then when you start producing a whole lot, remember what happens. And from the previous chapter, remember what happens. You get some effects of spreading from fixed costs, but those spreading really gets pretty shallow towards the end of, towards the bottom here, because your fixed costs are spread out so much, you don't really get a big impact from that. Your costs begin to really ramp up because, remember, you got some type of fixed input. And we like to think of it as floor space in a bakery or acreage in a farm that prevents your variable input, which we usually assume to be labor, prevents the labor from working efficiently because they begin bumping into each other, so to speak. And so your costs start to ramp up. And that's what we're seeing here. So when your costs ramp up on both ends, you got, on a per unit basis, you got fairly high costs at the low end and at the high end. Now let's continue with this table here. Let's look at average total costs, column 5. And when you hear average total cost, you should think U-shaped. And that's the U-shaped curve. And let's see, is it U-shaped? Well, it starts out at 1803, drops. Oh, bottoms out somewhere around 300 units, which is somewhere approximately to our efficient scale. So remember, the term efficient scale is at the bottom of the U of the average total cost curve. And that's basically, what we think of as an optimal size for a firm. But we have more to say about that, so hold on. And so you see average total costs start ramping up, like we said here, and that's because of labor being less efficient over quantity as you increase quantity. Now your average variable costs should look something like a U also, and it does. It comes down 13, 11, 10, and then starts ramping up. And you can see the difference now. See the difference between your average total and your average variable. That difference gets smaller and smaller, and that's the effect of spreading. After a while, you're spreading those fixed costs very, very thin. It's not going to have much of a difference between your average total and your average variable cost. Now, your marginal revenue is your change in revenue as you change output. That stays fixed at $15 because the price, no matter what happens here with quantity, the price stays $15. So when you change quantity by 1 unit, you're going to gain $15. So that's your marginal revenue. And the marginal revenue is constant. Now let's look at column 8, marginal cost. That marginal cost curve, if there's specialization, should look like the Nike swoosh. And it does a bit. It starts out at $13.03, drops down to just under $9, and starts ramping up. Now, remember what's causing that marginal cost curve to drop initially. That's coming from specialization. So specialization is the cause of that drop initially in the marginal cost curve. It can't come from the spreading of fixed costs. Keep that in mind because fixed costs are fixed. And so when you look at the definition of marginal cost, you're looking at the change in total cost. the change in total cost has to only come from variable costs. So it's not coming from the spreading of fixed costs. That drop initially in marginal cost for the Nike swoosh is coming from specialization. And then eventually what happens is as you go down, the marginal cost goes up, and that's due to the inefficient use of labor, stuck in a sense by that fixed input space, right, floor space. Now, the last column is your change in profit, and that's again on a per unit basis. And so you're looking at $1.98. It's going up a bit, and then at one point it drops off to zero. Interestingly, look at this right here. Marginal revenue equals marginal cost. Your change in profit is zero. That's where your profit, that upside down profit line kind of plateaus and flattens out at that point. Another thing that you can see from this graph is you can see that when marginal costs are below average total cost, the average total cost curve is dropping. And then eventually what happens is when marginal cost goes up and it's higher than your average total cost curve, you can see the average total cost curve is ramping up. That's what we discussed visually in the previous chapter. Let me move over because you can only gain so much intuition from the table. The table is important. Be able to compute these numbers because it's the underlying foundation to what's going on. But we got to move over to the graph because you get the much better intuition when we look at things graphically. So that's where we're going next. So the purpose of this visualization here is that we can better understand not only what's going on in this table, but we can figure out where the supply curve is coming from in a perfectly competitive firm. Where is the supply curve? So first off, notice that this is dollars because this is not only costs, but it's also price and marginal revenue, and marginal costs are here. So I just denote it in general with a dollar sign. Now here's our marginal cost curve. Here is our average total cost curve. And here's our average variable cost curve. And you can see the spreading of fixed costs coming about, and those fixed costs shrink pretty quickly as you go on. It kind of looks like this. So remember, the spreading of fixed costs as your quantity goes up this way, fixed cost, the effect is big early on, and then it kind of flattens out after a while, just something small. And that little small gap is right here. So what I want to do is let's look at what happens when you start out with a low price in the market. Let's say the price is $7. Remember, the price is dictated by the market. This is a baker. It's a small bakery. It doesn't have any control in price. And so at $7, if this was the market price, we show the price curve here, which is marginal revenue, by the way. And so that's an important point. The price is $7. P is $7. The marginal revenue is also $7 because every unit you sell, so if you have one unit and you sell 2 units, your marginal revenue is $7 because, look, the price stays fixed. You sold another unit, so that's your marginal revenue. So your price and your marginal revenue is this. It's flat because no matter what, no matter how much this firm produces, it's a small bakery. It can't influence the price of the market, and so we imagine that it can just sell at $7. But the question is, will it produce? Will this firm produce at $7 if that's what the market price is? The answer is obviously not. I mean, look at this. If the market has a price of $7 and your competitors are all selling at $7, look at your cost structure. Look at our cost structure here. Look at it's way up here. Our bakery is grossly inefficient. There's no way it could operate in a market like that. The competition somehow has to have a cost structure that's much more efficient than that to be able to sell at $7. So in this case, our firm is not going to produce anything. So the output is going to be zero. And the same thing if the price came up. Now what happens if, the price comes up to this point? What happens? And what is that point? Well, that's the bottom of the marginal cost curve, and that's got to be right about here, about $9, $8.98. So we'll just put about $9 here. Should we produce there? So if the price of a cake is $9, should we produce the number of units here? Well, 9. Should we produce at around 100 to 200, right here, 100 to 200? So we'd have 100 here, 200 here, imagine. So the question is, do we want to produce? And the answer is no, we don't want to produce. The costs are way up here. And at this point, the costs are way up here. And what does way up here mean numerically? Well, it's your average total cost. It looks like it's between $18 and $13.50. Call it like 15-ish, around $15. So your costs are 15. You're selling it for 9. You're losing $6 a cake. So you're never going to produce here. You're not going to supply anything. So again, your supply curve. So basically, supply curve is here. Okay. Now, what happens if we can produce at this point? And at this point, well, where would we be here? We got to be below the average variable, right? Here's the average variable. So we got to be below the average variable minimum here. And so somewhere we're like down here somewhere. Yeah, the price has to be below this average minimum, the minimum average variable right here. And so now the question is, should we produce at this point? Let's say it's $10. Should we produce at 10? Well, again, we're not even covering our average variable costs at this point. Okay? Here's our total costs, our average total, it's way up here, and we're not even covering our average variable, so that's not good. Now what happens if the price comes up a bit more? Ooh, right to the bottom of the average variable cost. Now it's $10.67 at this point, right here. What is happening at this point? Well, we're just covering our average variable cost because $10.67 is our average variable cost. So we're kind of indifferent as to whether or not we want to produce. At least in the short run, we're indifferent. Now, if the marketplace price was a bit higher, right? Then if we were at this point right here, oh, okay, we're starting to cover our fixed costs. Remember, this spread is our fixed costs. We're covering our fixed costs, but we're not still covering all of our fixed costs. We're not up here to the average total cost curve. So we still have problems. In the short run, we might want to operate here if we think the marketplace was going to get better. But you can't stay here forever, because forever would mean for a long term, you'd be losing money and you'd be out of business. So the point is, what's going to happen is you're not going to produce anything. All the way up to here is the supply curve is 0. And now, let me shoot over to red here. Now the supply curve for the firm, I'll put it off to the side here so you can see it. The supply curve, at least in the short run, is going to be here. So anything in the short run will be up above this point. Okay, and that'll be the supply curve. So the supply curve kind of looks like this. Okay, it's starting to look like that shape. And eventually, when we get to the bottom of the average total cost curve, and the average total cost curve bottom is around $12.33. So we get to a price of around $12.33. Not only are we covering all our average variable costs, but we're covering our fixed costs. And from then on, if the price is higher than that, then from a long run perspective, we would be producing here. Okay, so we would never produce here. Long run or short run is 0. Then we would produce in the short run a little bit here, right? And then the long run goes up further. Let me make sure I got that clean for you. So this would be the long run. You can operate in the long run as long as the price is above your average total cost. And if you're here, if you're operating here, you can only do so in the short run because you're not covering all your fixed costs. And in the long run, you could not operate here because in the long run, if you're not covering your fixed costs, you're in trouble. So therefore, the supply curve is kind of this weird shape, and it depends on how far you go up, depends on whether you're in your short run or in the long run. So let's clean this up a bit. Look at things a little more carefully. Okay, make sure we hit home here on what's going on. Here's our cost curves. Here's price, which equals marginal revenue. And we conceptually think of just what would happen if price would increase, if we had an increase in price, and where we would be profitable. And eventually, you know, we know that we wouldn't supply anything until we get right at this point, and then we'd be willing to supply at least in the short run right here, for sure, when technically the short run could go all the way up to this point. But we can only operate in the short run. We can't operate in the long run here, because in the long run, you have to cover your fixed costs. And then here, this would be the long run area of the curve, because that's where we're making more than our fixed costs. Now, remember what's going on in the discussion that we talked about earlier. We're using marginal analysis because each one of these prices is equal to marginal revenue. We're using marginal analysis to determine quantity, the Q. So we're looking at where marginal revenue hits marginal cost, and at this quantity, we're asking ourselves, should we produce at this point? And in order to make that decision, we need to know where our costs are in order to know whether or not we're making a profit. And if we're making a profit, well, here, we're not quite making a profit. We're covering most of our fixed costs, but not quite all. We can't stay here for very long. So we operate temporarily. And if we can't do that, we have to shut down. And then we can, if price is higher than our cost structure, so to speak, we can operate only here in the long run. Now, let's clean this up and ask ourselves, well, how much profit is the firm making? How do we measure the total profits of the firm? Here we have a nice cleaned up graph. And let's look at what happens is, let's say our price, which equals marginal revenue, is right here. Okay, so remember, margins determine our quantity, so we're going to produce here if we can. And let's see, is it profitable to produce there? Yes, it is, because we're going to take price minus the average total cost, and that's going to be our profit per unit. And that's here. Profit per unit is right here. And so we're going to take Q. This is Q from here to here. This is quantity. And this is going to be price. And this is ATC. So price minus average total cost times Q is going to equal our total profit. So I should put total here. That's this whole area. Okay. Now what happens if the price is down here? Okay. Well, if the price is down here, and assuming it's above the average variable, so the average variable might come down something like this, average variable cost. And we're looking here, and so here's our price equals marginal revenue. And so here's marginal cost equals marginal revenue right here. So we ask ourselves, can we produce here? And the answer is no, because here is our average total cost. It's price, well, it's actually average total minus the price in this case, because average total is higher than the price, times Q is going to be our total profit. And our total profit, so here is the ATC, this part, is right here. And then here's our Q, this part. So this is our, oops, this is our loss right here. Sorry, this is our loss right here. That is our loss, total loss area associated with that. Now the next part of the story here on perfect competition is interesting because it's going to lead to one of the most powerful predictions in all of the model of perfect competition, which I think is even more interesting. So let me give you the setup here. What we want to do is make a distinction between the firm's supply curve and the market's supply curve. So here we have a firm, firm, quantity, dollars, and here we have the market on the right, quantity. And we know that the demand curve for the firm is perfectly elastic, and so we have a supply curve, which is the marginal cost curve to a firm. We can, if you'd like, we could put in the average total cost curve here. The firm is in equilibrium right here, which we'll define a little bit better in the next couple of minutes. And so if this is 10 units for this individual, remember, if these are small firms, they're atomistic relative to the whole market. The market is much bigger. And let's say there's 1,000 firms here. Then what that means is there's a supply curve for the firm, or for the market. I'll call it the short run supply curve. SRS for short run supply curve. And that'll be, that supply curve at this particular price for them that's going on here will be, if there's 1,000 firms, it'll be 1,000 units where the supply curve aggregates. So what I'm saying here is this supply curve aggregates all these individual firms up. If there's 10,000, if there's 1,000 firms, each make 10, it'll all add up to 10,000 units supplied. And what I'm going to do is I'm going to show you, look, on top of this, here's a demand curve. And there's a demand curve, and you go, wait a second. How can the demand curve here be flat and the demand curve for the market to be downward sloping? Does that make sense? And the answer is yes. There's nothing unusual about this particular market. If you think of it in terms of the cake market we've been talking about, it's a standard market. When price goes up, demand goes down. You know, we move up along this demand curve and quantity goes down. Well, just like we've been studying all along in this course. So why is it that demand curve is downward sloping? Well, recall, when price goes up, those grocery stores that are demanding these cakes, they can find close substitutes. There's substitutes out there that they can buy into. They buy, and so when price goes up, they'll substitute out of that, move up along this demand curve. And so demand will be reduced when price goes up. So let me clean up the canvas so we can analyze one of the most interesting and powerful aspects of this perfectly competitive market model we've been looking at. So here we have the firm, here we have the market. And we're going to explore what happens when there's an increase in demand. So demand increases, and from the marketplace, we know we're going to move up this short-run aggregate supply curve from point 1 to point 2. And what that means is price is going to go up. There's nothing unusual about that. We go to point 2, price 2. And that means we're going to have a new price, and the whole demand curve shifts up for this small firm, demand 2. And we'll look at what happens. The cost structure is remained unchanged. Marginal cost, average total costs are remaining unchanged. There's a sudden increase in the market price. And the price goes up, the P2, and we're going to move up along the marginal cost curve. And this firm is going to supply more, and it's going to sell at a price of P2. It has a cost of this average total cost. This whole area, almost this whole area, is going to be profit. Basically from here over, this area here will be profits. And what do you think is going to happen when a firm in a perfectly competitive market starts to show profits? Well, what's going to happen is it's going to attract other firms. Other firms are going to come into the market, and they're going to want to steal these profits. They see the price going up in the market, and that's a signal to them that they should go into the market, and basically they'll go into the market to grab these profits, to steal these profits. And so what's going to happen is you are going to see a supply curve shift out. So we're going to have a new supply curve, short run supply 2, right? And we're going to end up at point 3. So we have an increase in the number of firms. So new firms move in. So remember, this was a fixed number of firms. Now we have a whole bunch of new firms move in to steal those profits. The supply curve shifts out. We end up with a new short-run supply curve. And what happens is, from this point of view, we started out here at a long-run equilibrium where there were zero economic profits at that point, right here. So that's important. We're not talking about accounting profits, zero economic profits. We're covering all of our costs, including those implicit costs like financing costs. So the firm is quite happy to be earning zero economic profits because it's got all of its costs covered, including a profit and a profit for the owners of the firm. And so this firm sees even more profits available. So the price goes up, it moves up its marginal cost curve. Quantity expands out to the right a bit, starts earning these profits. Other firms see there's profits being made. And what happens is competition moves in, moves this supply curve off to the right. The price drops. And we end up right back to our long-run equilibrium with zero economic profits, but still attractive industry to be in. And so there's the point. We end up right back to where we started from. And now what's interesting is we end up with a long-run supply curve for the market. Looks like this. Long-run supply. And that long-run supply reflects the flexibility of those new entrants into the market. So this firm, we call this an existing firm. So this firm existed throughout all these changes that went on, and it withstood what was happening. Now, what I'm going to do here now is invite you to reverse the process. What I mean by reversing the process, this demand curve shifts to the left. Suddenly there's a decrease in demand. People, for some reason, don't like this particular cake. So there's a decrease in demand. Market price drops. We start from point 1. We go down, and this new demand curve is down low. The firm is making losses because the price is less than average total cost. It's making losses, and that's going to cause other firms, so we'll keep this firm in business here. That'll cause other firms to want to move out of the industry. And they move out of the industry, the supply curve that we saw here is going to shift up and to the left. And we're ultimately going to be to a point here. So we moved out on this straight line to the right, and when there was an increase in demand, a decrease in demand, we're going to end up out at this point. We're going to end up right here for the existing firm with a zero economic profit as before. So what I'm inviting you to do is actually graph this out. Don't look at the video. See if you can duplicate these existing graphs and be able to explain the process of a decrease in demand for the market and how it affects an existing firm's profits and the mechanism to get us back into a long-run equilibrium. So one more thing about this. Now, when we go back to the point where we're making profits, the firm was making profits and firms entered and they stole these profits. That was because there was no barriers to entry. Remember one of the assumptions we started out early in this video? There was no barriers to entry. So firms, when other firms know that there's profits being made, they're going to come in and swoop down and steal those profits. Now, the exact opposite's going to happen when there's the decrease in demand that I'm asking you to try to model on your own here, and price comes down. What's going to happen is this firm's going to lose money, and other firms are going to realize that, well, not other firms, the firms that are in the market are going to realize that. Some of them are going to bail out of the industry because there's free exit. There's no barriers to entry. There's no barriers to exit. There's no regulatory issues involved here. You just leave the industry, and there's no costs to it to leave the industry. And so when firms start losing money, the number of firms start shrinking in the industry, and you start moving back up. The price starts moving back up, and supply curve is shifting up to the left.